Hi, and welcome to Future Focus, a financial strategies podcast where we make the complex simple. My name is Troy Branch, and I'm joined here by my colleagues.
Keely Joe, yo. Hello.
Keely Joe, yo. Okay. Did not expect that in the intro. And
Well, Jacob, Troy, I know what you're probably thinking. You're thinking it's summertime. It's still the end of summertime. Where's the Hawaiian shirt? And for that, sometimes even Magnum PI needed to change the wardrobe a bit. So we got a little wardrobe change today.
Apparently I missed the memo on pink.
It's not Wednesday, but
Yeah.
we wear pink.
This is more reddish than pink. But
No, that's pink.
That's
Yeah?
pink.
That's pink.
either way, I like it.
Okay, I'll give you salmon. How
Okay,
about that?
yeah, there we go.
All right. So a couple of housekeeping notes before we get started, and I know I'll talk about it at the end. But for those of you who are listening to us, and I say that because we are now on all your regularly scheduled podcast platforms, whether it be Spotify, whether it be Apple Podcasts. You can now listen to Future Focus if you happen to be watching us. So we're going to do our best to make this a podcast that you can both listen to and you can still go view on YouTube. How's that?
Yeah, I like it.
All right. So what are we doing today? Today, we're going to talk about one of our one of our staple topics. We're going to talk business owners. Now, hold on. Well, I know we've talked business owners in the past, and we'll probably talk we'll talk business owners in the future.
It's been a few episodes since we've talked business owners, right?
Yeah, and this one, I'm excited about this one because we're going to dive into the business owner, and actually we'll probably be dealing with some financial professionals that work in the business owner marketplace. Businesses, like you can talk to a business owner depending on what stage of the business that they're in. And we'll sort of explain the stages here, but depending on what stage of the business that, they're in, you could get many different questions. You can get much different questions. You can get much different answers. And you could be talking to the same business owner at year 2, at year 5, at year 7, at year 10, and so on and so on and so on. And you can get different answers to the same question. So today we're going to focus in on the business owners and the stages that they occupy. This is probably going to be, actually, I know it's not probably, this is going to be a two-parter.
No way we get this done in 25, 30 minutes. So.
No way.
No, I think breaking into two parts, let's just talk those stages. And like you said, stages, hey, they may have a lot of the same problems, same risks, same questions they're thinking of, but depending on the stage of business, they probably have different concerns that they're looking to address.
Absolutely. So here's what we're going to do. We're gonna set the stage, the proverbial stage, like literally the proverbial stage that the business owner is in. We're going to deal with 5 stages across these next 2 episodes. What I'm going to ask you is to put yourself I'm going to give you questions that oftentimes the business owner is considering. The business owner is thinking about. If a financial professional is involved, a financial professional might be asking that business owner. So I want you to take that perspective when you sort of answer that question and think about what stage the business owner is in. Okay, so let's go ahead and sort of dive in and make sure I get to the part. So we've had like many things that we do. We have the advantage of having had these conversations, and it's kind of what we do. When I think about business owners, the stages that a business is in, I actually think about the 5 stages that we've named. Now, some people may come up with something different. This is kind of how we think about it. The first stage being startup, the next stage being growth. We're going to talk about those 2 today. In part 2 of our conversation, what is the business owner or the business thinking when they are established and then they become more mature, or we think about that maturity stage, and then the final stage is that transition. What is it? What does that look like? So 5 stages, 5 different times. That depending on what stage that business owner is in or the business is in, you're going to get much different answers. And that's kind of what we want to illuminate over these next 2 sessions. Okay. All right. So let's dive into, get that off. So let's go ahead and dive into part one where we talk about startup and growth. Okay. Good. All right. So let's so when we think about the startup stage of a business, right? Let's like put yourself in. We have the advantage of talking to financial professionals and in some cases talking to business owners, or we happen, like, I know that each one of us has business owner
some personal
somewhere
relationship to a business owner
in our personal life. That's okay. So think about that startup stage. Like let's describe that first. Like that's the stage where the business owner and the business, it's hard to separate their assets and what they do and the debt they have. Like the business is the owner and the owner is the business. Like, so let's just paint that stage. It's all the risk is on the business owner. All the work is on the business owner. Like they're thinking about, am I actually going to, like, is this actually going to work? Is this going to survive? So that's that's sort of the stage when we think about startup. And if you happen to be a business owner, either listening to us or viewing us right now, does that sound familiar? Are you in that stage right now, or are you, or do you remember that stage? Right? That's the startup stage. So here's the question that that I have for you. That question is, if I'm a business owner, or if I'm sitting in front of a business owner and I ask you this: if you didn't come to work for 90 days, this is me talking to the business owner. If you didn't come to work for 90 days, what would happen to the company and to your family? Where does that put you at?
So if I'm that business owner in the startup phase, that early stage, I mean, to me, that is the stage that the business might be the most fragile. Without proper planning, that business could collapse very quickly. I mean, if there's a death or disability, revenue of the business is tied to that business owner, and primarily to that business owner, things could happen negatively in a very short instance.
Absolutely. I mean, coming from the attorney side of it, what I think of immediately is liability shields with startup businesses. And what I mean by a liability shield, before I get scolded.
Go ahead.
So when you have a startup, you don't really think about, okay, what kind of business do I want this to be? You're like, I'm a sole proprietor. This is just a thing. I don't even think about getting attorneys involved at this point in time, or a financial advisor or anything like that. But really, when you first start off as a business, you should think about that. Because if, as you said, you are the business is you don't want your assets to be tangled up if that startup goes under. So you want to think about things like a liability shield being, depending on how you organize your business, it'll separate you from your business. And so your assets can't be touched if the business goes under, if the business faces a certain liability, versus if you stay entangled and enmeshed, essentially everything could go down together. So I'm thinking of, are you going to be a C Corp, an S Corp, et cetera? We don't have to go into each of those today, but it's important to know what entity type you're going to be when you start your business.
Absolutely.
I think with that too. So that's the entity type. I think some additional risks that come to mind that an owner might not be thinking about or underestimating as they're trying to get the business off the ground. I kind of wrote down 3 here so I could remember each. The first one we touched on, obviously, all right. Number 1, the owner dependency. The business is the owner. So how are you going to replace that owner's skill and revenue if something happened to the owner and there's not a whole lot of employees yet at the business? That there may not be a whole lot of cash reserves or a backup plan yet, to cover expenses if the business owner is out. And then we kind of mentioned this one as well, both disability or death. If something happens and there's that interruption to the business, the owner's business, that business might be over before it's even getting started.
Well, not just that. When you sign up for a business, let's say you rent a space for it. If something happens to you, say you get disabled or whatever, those utility payments, that rental payment is still due no matter what. So again, you don't want to be enmeshed together, but there's other things you can do to mitigate those risks, such as buying types of insurance. You could do like a business overhead insurance, which would cover those bills. You could talk about disability insurance when it comes to making sure that the income is still rolling in and you're not relying definitely on working. Or if you pass away, heaven forbid, You can look at life insurance to make sure those bills are paid. We don't want to leave that burden on your family, even if it's early on.
I wonder how many people, I guess I'd like to think that everyone sort of realizes it, but like you talked about liability shield. Yes, that does, but almost always, if I'm at if I acquired a loan at a bank, even with liability shield, you're still signing a personal. There's usually a personal guarantee that that the business owner signs with the bank.
Because the business doesn't have any assets.
Because the business doesn't have any assets. So it's a critical time to be thinking about how you're oftentimes you're doing it to protect your family, and the last thing you want to do is put your family in a lurch. Because something unfortunate happened and the debt accumulated needs to be dealt with.
Right. Mm-hmm. So we talk about all the time, from a life insurance. I mean, you mentioned the income replacement for the family, what you're getting at using the life insurance for collateral for a loan that you may have taken out from the bank. So, a lot of times we see term life insurance may be used in this stage because that may be more cost effective than, say, a permanent life insurance policy for that business owner, and you had talked about disability, and the business overhead expense or the individual DI. All of those are great tools to help continue the business, and not just being a financial tool, but being able to help from a business planning perspective, making sure that you can stay growing from that startup stage.
And you mentioned something about using life insurance as collateral. When you're in a startup business, because the business doesn't have very many assets, and you probably don't either, oftentimes a bank is going to require life insurance when you have a policy or a mortgage or a big amount that you're taking out anyway.
Yeah. It's weird that we and that's you're in the startup stage and you're literally just starting out, but you're trying to risk mitigation becomes that base level, almost like when you think about if you think when you think about how folks put their lives together, you think about that risk mitigation as that base level, that sort of big base that everything else is built on. And it's really no different from a business owner standpoint. That does not make for a good audio podcast. People cannot see my hand, so I apologize.
Well, see, there you go. So if you're listening to us in the car, you're listening to on a walk, hey, go check out YouTube, and you can see Troy moving his hands around.
Exactly, and especially when I'm a hands talker. So this does not make.
Did he hit the table at all?
I did not hit the table.
No, we have a sign. We're ready. If you hit the table, you're putting a pebble in.
There's a new rule at the table. 30 episodes in.
New rule. It's been a rule.
You hit the table, in goes a pebble.
There's just a punishment now.
Exactly. There is a consequence now. So risk mitigation is that base. Is that base that whether it's personal financial planning, or whether you're thinking about a business, it's still the base when you're even in the startup stage.
Yeah, it's that foundational planning.
Absolutely.
Yep.
Absolutely. Okay. So that's, first of all, anything else?
I would throw one more thing on there, just kind of going back to entities. When we're also thinking about entities, I know you're not thinking about getting out of the business, right, when you're getting into the business, but your entity is going to actually impact how you get out of the business. Not just that, it's going to impact, I'm not going to go into 1202 because you're going to get penalized. I'm going to get penalized for that.
He's not going to get penalized.
No, not me. But also, it's going to impact how you get money out of the business moving forward.
All right, I promise I will not make you put one in
Liar.
if you give us 30 seconds on why the entity selection for section section 1202
of the Internal
Revenue Code. See, if you had to throw that in, I almost making that, but 30 seconds on why that choice, frankly, is becoming more popular now.
Yeah. So 1202, it applies only to C corporations. And essentially, without going into specifics, if you go to sell your business later on, if you have a gain in that business, you can exclude up to $15 million or 10 times your aggregate basis. And I'm not going into basis, but essentially, you don't have to pay taxes on the capital gain.
You had to define it in the game.
I've defined basis so many times.
I tried to define it, and I struggled with it and got very minimal points.
Personally, I'm looking at, so I have family members that are entrepreneurial and starting businesses and doing, it's a really, it's a serious consideration young and a startup, but it's a serious consideration to think about actually being a C corp, because there's such an advantage, down the road if I decide to if they decide to sell the business, whatever it amounts to.
Not just that, like it's really hard to switch later on. People can be like, oh, I'll just be an S corp today and I'll switch tomorrow. Well, it's not that simple.
Right.
But also I wanted to tack on there, it will impact how you get your money out of the business moving forward. If you're a certain type of business entity, it's taxed at the entity level and then you have to go through the entity to get it out. But if you're a pass-through, you could get it out in a tax-advantaged way. It really impacts how you're going to get money out of the business going forward and how you're going to be taxed.
I get it. Double taxation, single taxation, all questions to consider.
All questions to consider.
Yeah.
It depends.
Do you want to define double taxation?
That's it. You're getting taxed at two levels, at the corporate company level and at the individual level.
Okay.
Can't stump me.
It's not meant to stump you. It was more so you need to pay.
Just for that, I'm going to try and stump both of you. Before we go to the next one, I will put a pebble in the jar if you get this question right. I mentioned Magnum PI with the theme of the Hawaiian shirts that we've had to start the year.
Go ahead.
You name both actors that have played Magnum PI. I will put a pebble.
Isn't Jim Carrey one?
No, it's Tom Selleck. And
you gotta name both.
Hold on.
He's working on the second one.
He's Spanish. What's his name?
Oh, I don't know. You're carrying the team here.
I absolutely know it. I know who the Higgins was. What's his name? It's not Ramon. That's Will Trent.
Well, you tell you what. You keep thinking on it as throughout that. You have to the end of the episode. Okay. I'll put one in. I know because I like the reboot of the Magnum show.
I liked it too. Yeah. Actually, yeah. Anyway, okay. So startup stage. Right, we understand it's that feeling of I'm the business is me, I'm growing, and, or I'm not growing, I'm wondering if I'm going to make it, right? And so then there comes a point where you sort of turn the corner, or you're crest at least one of like this, you're crest the hill, and you're like, all right, I think I want to make it. Now it's a matter of what am I going to do? What am I going to grow to? And that's where we move into the second stage, this transition from startup to a growth company. I'm growing. I'm doing well. But guess what? I probably didn't do it by myself. I've grown to the point that I've added some folks, that there's a handful of key people that have gotten me over the hump of, am I going to make it, to I'm growing, and it's a matter of how big am I going to get? That's what's usually punctuates the growth stage. So with that in mind, and we think about like now being that business owner, same business owner, but I'm in the growth stage. Here's a question that I have for you is, who are the 2 or 3 people, I'm sitting down with you as a business owner, who are the 2 or 3 people that if they left next quarter would set you back 12 months?
So this is like a key person question. Who are the people that you're relying on in order to make sure your business grows? Now, these people, other considerations you should have is like, when you get to the point where you're in growth, your key people could become, and I like how it was put here, visible to competitors. So they could be your competitor actually moving forward. So by what I mean by being visible to the competitor is they are growing with you, growing with the business. They've become indispensable to the business. So if you have other competitors, the first thing they're going to do is try to poach your employees. Not just that, so you need to have an exit plan in case those employees leave. That way your business doesn't go under. But you should also have documentation stuff in order. I like to call it redundancies. I guess that's what everybody calls it. Having some redundancies put in place so that if that key person were to leave, you aren't going to be completely lost without them. You can easily train a replacement, get them in, and keep the business moving and growing.
Yeah, but that's the problem, though, isn't
it? That's the hard part.
Maybe not easily, but have a plan in place to say, okay, what are some ways I can maybe keep this key employee at the business, or if I do need to replace them, maybe I have a process or a plan in place to bring up the next individual or bring in, someone from the outside as, like you said, business is growing, revenue's growing, operations growing, so potentially more dollars coming in, more people coming in, less of an impact of needing to be focused on what the business owner is doing, more on, like you said, what those key individuals are doing to help drive the different areas of the business.
The business owner can become more big picture and not day-to-day operations.
Dare I say, do you have someone or multiple someones that you need to recruit, retain, or reward?
Yep. Because, I like you say it all the time, Troy. Your key employees could be your biggest competitors if you don't do anything about it. You want to incentivize them to stay in the business, to work for you, to do a good job, and to align their interests with your own.
I can't claim that one though. Like I'm just
saying, I hear it from you all the time.
Well, that was absolutely stolen from Keith Gillies. Like when the episode that we did with him, he was the one that pointed out, it's not just recruiting, retaining, or rewarding a key employee. Oftentimes it's keeping your key competitor like right next to you. Like that's and I hadn't thought about it that way until he said it. So I appreciate you. I appreciate the attribution, but like I can't. That was from Keith.
Well, and a secondary question to all this. So I know we're talking a lot of the key employee at the growth stage, but question for the both of you is, what are there additional risks that a business may need to be aware of if their business is in that growth stage of the life cycle?
Make sure your documents are growing with you. What do I mean by that? If you have a buy-sell that's put in place, make sure that the valuation for the company is growing, because your company is growing, so you need to make sure that you're getting a price that actually matches that growth. You need to make sure that the type of business that you've been organized as is still working for you. Is a partnership not working for you anymore? Maybe you need to be an S Corp or a C Corp. It's making sure that you're reevaluating those types of planning documents. And I know it's kind of painful to think like it's administrative. That's not what you think when you think big picture, but it is just as important when it comes to running your business.
But this is the stage in which you're starting to take those first steps to working on your business instead of in your business, right? Like you have key employees and you are starting to think big picture and what do I do to continue to scale and grow and do all these things. So that is the time to be thinking of, about those types of things, keeping those documents up to date, making sure that you understand valuation. Those are all things that when the opportunity comes to either I need to reward a key employee or I need to maybe grow by acquisition, having all those I's dotted and T's crossed makes a world of difference when you're talking about growth. So when an opportunity comes, you want to be ready, not have to get ready.
Yeah. And make sure you don't grow too fast that you can't handle it. You don't want to be at a point where like you don't have the systems in place or the people in place, but you're growing, that you lose the quality of your business. I just want to throw that out there. I've seen it happen to business owners many times where they're like, this is amazing, we're growing, I'm going to open all these new locations, and then they neglect the old ones. So I just want to throw that out there. Let's not grow too fast that we can't maintain that growth and keep our brand image.
It's funny, I just had that conversation with my wife about a sandwich shop in town here that did that very thing, expanded too fast. Sandwiches were so good, people standing around the corner at lunch. And like when I was in law school and then they started to franchise, grew too fast, and then they were gone.
And you lost the quality and it all comes tumbling down.
Good.
Alrighty.
Nothing?
I was like, okay.
You got nothing.
I'm just thinking about sandwiches, so.
Exactly.
Yeah. I'm trying to think of what sandwich, without us saying it, I'm trying to think of what sandwich shop you might be talking about, so I'll have to get a guess when we get done recording. I'll have to ask you.
All right. Well, I think because of the introducing it and like introducing the segment, we're going to stop at the first two stages, the startup and growth. We're going to pick up the conversation and make sure I get the other stages correct, because we're going to move into to the established stage, to maturity, and to transition is where we're going to pick the second part of this conversation up. I would be remiss if I didn't tell everyone that everything we've discussed here today, hopefully everyone knows, is for educational use only. It's not intended to be specific advice. And if you feel like you would like some advice, that's where you seek out a financial professional qualified to answer your specific questions regarding business owners, regarding the stages and some of the things that we talked about here today.
And I would be remiss if I didn't say, if you have questions for us, please put them in the chat so I can make Troy wear Crocs for once. Please, 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 for our listener episodes, write some questions. If you don't feel comfortable with it, don't worry. We have an email that we're trying to set up here for you to send it to us directly. Again, please put them in the comments.
Well,
I really want to.
Yeah.
So I want to thank everyone for your time and attention. So this is going to be like.
Well, before we get to the outro, you don't have that second actor's name?
No.
Jay Hernandez.
I knew it. Yeah, Jay Hernandez.
Yeah.
Okay.
So
was he on? No, different. No, was he on Desperate Housewives? Was he the pool boy in Desperate Housewives?
Why would I know that?
I don't know. I'm just not sure.
I know that was an ABC show, but
absolutely.
So
Movie freaks.
Technically, those are TV shows.
Those are TV shows.
Same difference.
It's about the details. Yeah. All right, outro.
Thank you for your time and attention. Be sure to like, subscribe, follow, / do whatever you need to do wherever you do it, whether it be on Apple Podcasts, on Spotify, on YouTube. If you're happening to be viewing, be sure to do all those things. I'm told that we can now do like 5 stars and all the other good stuff. Make sure you do that as well. We look forward and what my colleague here has already said, make sure that you comment. So that someday, Bo juggles and I wear Crocs.
Yes.
All right. So are we happy with that now?
Yes.
All right. Okay. So thank you everyone for your time and attention. Be sure to tune in for the second part of this conversation, and we'll look forward to seeing you on Future Focus. Thank you.